All right. Okay, if we're live, we're going. So welcome to our AFA session on household finance. Before we get started, John Graham has asked to keep an eye out on your email inbox for this AFA climate survey. It's anonymous and it's supposed to provide a benchmark for the work environment and our profession, so that would be helpful. So we've got a great set of papers and three excellent discussants for those papers. The format will be as follows. We'll go about 20 minutes for the presentation, about 15 minutes for a discussant. Then we'll have a few minutes after there for the authors to respond to the discussant or address questions from the audience. Those questions will be run through the Q&A feature on Zoom. And so as the presenters are going about their work, explaining what they're doing, go ahead and pop in there and drop any questions or comments you might have. So without further delay, I'll turn it over to Michael, who's going to tell us about working more to pay the mortgage, interest rates, and the labor supply.
Excellent. Thank you very much, Taylor, for chairing the session and for allowing me to present my work, indeed, on household debt, interest rates, and labor supply. So I assume you see my slides. If not, I will hear from you in a second. But let me start. So by now, we know very well that household debt, household balance sheets have important economic consequences, in particular for the matter for transmission of monetary policy. But most evidence that we have about it is about consumption behavior. In short, we know that when interest rates change, households with debt adjust their consumption. We also have evidence that this actually drives the entire, the aggregate consumption response. And so, of course, that's important. Consumption is an important economic decision of households, but it's not the only one. And in particular, on top of deciding how you spend your money, you need to decide how to make money and how much money to make. So these labor supply decisions, I think there's good reason to believe that this could also depend on household debt, that this could be related to the changes in the interest rates. If you think about, let's say, an increase in interest rates, which increases debt payments, makes servicing debt more expensive, households with debt need to get this money from somewhere. And of course, they could change other consumption, but they could also respond by working more. The question is, however, is such a labor supply response or non-negligible labor supply response realistic in the world where not everyone still drives for Uber and where, of course, there is a lot of frictions in potentially adjusting your labor supply? So the goal of this paper is basically to shed light empirically on this relationship to see how important that is and what mechanisms are behind this relationship. I'm going to do that in the context of Polish mortgage and labor market. And the key feature of this market, the key reason why I'm looking at it, is that almost all mortgages in Poland are floating rate, which means that households are exposed to changes in their reference rates, like LIBOR. So when LIBOR changes, monthly mortgage payment for pre-existing mortgages changes. And my goal is to see how labor income responds to this kind of changes. The main result of the paper is basically the positive relationship between the level of mortgage payments, and which is driven by the level of interest rates, and household labor income or labor supply. The magnitude is substantial. Around 35% of the change, or the, let's say, increase in payment, is covered by higher income. And we're going to see a couple of dimensions of heterogeneity. The effect will be higher for higher payment to income ratio, for more flexible sources of income, and for places, for counties with lower unemployment. I will also show you a couple of mechanisms which drive at least part of this response. And we'll take a quick look at the consumption response, which also accompanies the labor supply response and is to a large extent responsible for the remaining 65%. So that's just a quick preview. And let me also tell you where I believe this paper fits more broadly in the literature. So first, it's of course related to the literature on the economic consequences of household debt. And there, I think the main contribution is that is this labor supply angle, which enriches our evidence, which so far was focused on the consumption behavior. At the same time, there are papers which talk about the link between household debt and labor market behavior and outcomes, also about labor supply interaction, although from a very different perspective, thinking more about the debt overhang channel. But even more broadly, we could also think about mortgage payment as just a type of consumption or large part of consumption which is committed because it's hard to change. And in that sense, I'm looking at how prices, a shock to the price of consumption affects labor income, which relates to the broader macro literature and also the literature on labor supply elasticity. So I would be looking at the income tax data for the universe of Polish population between 2005 and 2015. And in that data, I will basically see what is on a typical annual tax declaration. So aggregate income from different sources like wages or self-employment profits, some basic demographics, and crucially, some tax deductions, including mortgage tax deduction. So this mortgage tax deduction will help me to identify a near universe of mortgage holders with loans initiated between 2002 and 2006. Okay, so this is going to be a subset of all mortgage holders. And the reason is that this deduction was abolished in 2006, but the households who started to deduct interest earlier remain eligible to keep deducting them till the very end of their mortgage, which basically means I will see them deducting in the whole sample. So of course, the downside of this is that I'm looking on a subset of mortgages. The upside is that this is a nice subset because almost all of these mortgages will be pre-existing, and so we're looking at we can abstract from endogenous origination. Polish mortgage market is pretty standard across many dimensions, including, for example, mortgage length. It's pretty healthy in terms of low delinquency, but the key feature is what I already mentioned, is that almost all mortgages are floating rate, which means that your monthly mortgage payment is partially capital repayment, partly interest. Well, that's standard. But the interest part is a sum of the reference rate, which could be LIBOR or a Polish counterpart, WIBOR, so Warsaw Interbank Offered Rate, plus a fixed markup. When the LIBOR changes, when the LIBOR changes, your payment changes in general. Of course, LIBOR changes every day. Your payment will be updated every 3 months, every 6 months, depending on the contract. But that generates substantial variation. This is the picture showing this variation. So the more continuous darker line shows the level of reference rate. Here, this is an average of LIBOR and WIBOR, but they're very strongly correlated. So that's not that doesn't matter too much. And the lighter line, the more stepwise type line, is the median level of interest, which I observe in my data. So there are 2 things to notice here. One is sizable variation in magnitude. So if you look on the right y-axis, this tells you that the median level of interest moves between 2,000 and 6,000 Polish zlotys per year. And I would say that if you want to think about dollars, that will give you a good understanding of the magnitudes. I mean, if you want to think how severe that change is for a typical household, thinking about moving from $2,000 to $6,000 per year, I think gives you a good idea given the purchasing power. So that's the first thing. That's the variation we're going to exploit. And the second thing, of course, is the clear link between the median interest payments and the level of reference rate. So you could see clearly that's a very strong relationship. It's of course not perfect, for example, because of delayed updating. But that's what we're going to exploit. I'm essentially going to look at how within household changes of the interest paid in that time period, driven by interest rate changes, how that influences labor income. Okay, this is the exact empirical specification. So I'm essentially regressing household I outcome, typically labor income in ERT, on the amount of interest they're paying, where this amount of interest can be instrumented with the level of reference rate times the exposure, which is the initial size of the mortgage. That's of a pre-existing mortgage. And this idea strategy, this is mostly to deal with some endogeneity concerns like prepayment or refinancing, which could be related to your income situation. But the key idea behind the specification is really comparison of the income evolution. So within household, income evolution of households with large mortgage to those with smaller mortgage or perhaps no mortgage. So it's a cross household comparison. To do that well, we control for time fixed effects, and then in a pretty generous non-parametric way for age and previous income, and so their interactions, their time trend specific to those interactions. So the key thing we have to believe, the key identifying assumption for this to make sense is that after controlling for this stuff, for age and income, macroeconomic conditions and interest rates in particular are going to affect people with different mortgage exposure in a similar way, except through the size of mortgage payment. Okay, so that's what we will try to measure. So of course, the key threat to the validity of this assumption is that mortgage holders are somehow special, that they are differentially sensitive to macroeconomic conditions. And on the one hand, taking a mortgage is not that exotic, so they probably cannot be too special. But still, this concern is real, and I will be worried about it. I think the main result alleviating this concern will be the consumption response, which we're going to see later. So I'm going to return to that later in the talk. So this is the main result of the paper, the main table. It shows clear, positive, and significant relationship between the amount of interest you're paying, so your monthly mortgage payment, and the total family income. So column 1 doesn't have controls, so the preferred specification would include the controls. We're looking at the columns 2 onwards. And column 2 only includes mortgage holders. So this is using only the intensive margin variation in the size of the mortgage. Column 3 also includes everyone else. So it's using both intensive and extensive margin variation. And that produces somewhat similar estimates. Also, when we use IV, here we're getting almost the same estimate. Here a bit larger, but still in the same ballpark. So overall, something between 30, 40%, 35% being, I guess, my preferred estimate, is the average effect of the size of the mortgage payment on income. Now, this is the number which I think I would like you to take home, although there is a discussion behind this number, in the sense that we would need to discuss something about gross versus net income, a little bit about some censoring going on in the data. We won't have time for that, but in short, there are some effects in the background which pretty much offset each other. So the 35%, I believe, is a good estimate on average. But of course, there are good reasons to expect that there is some heterogeneity going on here. And this is the first dimension of heterogeneity, which we'll be looking at. This is looking at the size of the labor supply effect by payment to income ratio. So we see on the left that for households with very small mortgages, very small payment, the effect is basically doesn't exist. And then it's almost monotonely increases in the PTI. Importantly, it's already significant for the interval between 10 and 20%, where most of the sample is. So this is something which I think is quite intuitive, but it's also consistent with the mechanism of the basic economic mechanism of the adjustments to higher payments. If mortgage payment constitutes higher share of your income to begin with, of course, it is harder to respond with adjusting other consumption, because there is less other consumption to begin with, and it probably contains more necessities. So it's harder to do it. You are more likely to rely on the labor supply response. Okay. Second dimension of heterogeneity is by the level of local unemployment, so by the local labor market situation. We do see, I mean, this effect is pretty similar in all specifications, but if we, let's say, focus on column 3, we do see that the effect is significantly lower in places in counties with higher unemployment, and the magnitude of that difference is pretty sizable. So if you compare two counties with, let's say, 5 and 15% unemployment rate, which is a quite reasonable comparison given the levels of the data, the 10% difference requires us to multiply this by 10. We see that basically going from high to low unemployment county doubles the effect. So the difference is substantial. And this is on the one hand, again, consistent with basic economic mechanism. When the benefits of increasing labor supply are higher, when it's easier to do that because there are a lot of jobs around, you are more likely to do that. But for the interpretation of the results, that also tells us that the effect which I'm documenting in the entire paper depends on the labor market situations. And so that's worth keeping in mind when we think about other contexts. And the final dimension of heterogeneity, which I wanted to show you, is by income type. So this shows that column 3 estimate is higher than column 1. So the self-employment profits from self-employment respond relatively more than wages. Pensions don't respond at all, which I consider more of a placebo check. Whereas, and so the fact that profits respond more, I think it's, again, perfectly consistent with the idea that people for whom it's easier to benefit from increasing labor supply do that more. Still, however, you see that the effect for wages is still quite sizable and significant. So a reasonable question is, how is that happening? And of course, the question is, many people have pretty rigid contracts, 40 hours per week, not much opportunities for increasing that on the intensive margin. So it's unclear how that may be happening, perhaps. And that's why I want to say something about the possible mechanisms. So I won't observe all possible mechanisms. In particular, I do not observe hours worked in the data. So I won't observe maybe the most natural mechanism, that is increased hours worked in your existing job. But I do see a couple of other mechanisms at play. And so let me perhaps jump straight to the results and discuss those mechanisms there. So column 1 shows that households are less likely to be a single earner household when the level of their interest payments is high. So there is a spousal labor supply channel at work here. Non-working spouse might enter labor market. Column 2 shows higher likelihood of supplemental income. So this is a measure which is based on the different income types, different income categories in the tax declaration. It's probably best to give you a quick example. When you're a university professor, you get a salary from the university. When you do some management consulting gig on the side or something like that, you're going to get some income from someone else than your main employer. This is going to show up as a supplemental income. That's what I'm capturing. And so this is more likely to happen when the level of interest you're paying is higher. And columns 3 and 4 look at proxies, arguably quite noisy, I should admit that, for changing jobs and for working locally, meaning in the same town where you live. And we see that when the level of interest is higher, you are more likely to change your job and less likely to work locally. So, I mean, this is somewhat speculative now, but this is consistent with a story that there is this nice job out there in a different city. It pays well, but in normal times, you don't want to take it because it requires long commute. However, when you really need the money, when the interest payments are high, you might be willing to take this job now. All right, so the last piece of evidence which I want to show you is about the consumption response. So of course, in the tax data, I do not observe consumptions very well, but based on some tax deductions, I have some measures of it or some proxies for it. I observe charitable donations, contributions to private pension schemes, and expenditures on broadband internet. Okay, that's one of the deductions. And as you could see, all of these measures go down when the level of interest paid is higher. So this is important for two reasons. First, this illustrates this consumption response. We know that from existing papers, like including Amir paper, but it's nice to see it going on here in the same data set at the same time with the labor supply response. This is, of course, not on those three measures, but this illustrates the consumption decline, which probably is responsible for the remaining 65% of the reaction. But the second reason why this is important is the identification concern which we might have regarding the main results. I said that the key threat to the validity of the identifying assumption is that maybe the mortgage holders are differentially sensitive to interest rate changes. Maybe the incomes just happen to be higher for some reason when interest rates are high. But if that were the case, we would normally expect that the consumption is also high. Of course, there is a strong positive correlation between income and consumption. And so if that was just some confounding factor, we should see positive numbers here. That's not what we see. We see the opposite. And this is perfectly consistent with the story of adjusting to higher payment, but inconsistent with this differential sensitivity to macroeconomic conditions. Okay, so let me conclude. What I'm showing in this paper is that when interest rates change and mortgage, and that drives the changes in mortgage payments, which in turn drives changes in labor supply. The magnitude of this relationship is pretty substantial, but it's also clearly depends on the labor market conditions. There is, of course, a question: how widespread is this effect, is this correlation, or this causal effect? What I did is I've looked into a couple of maybe more popular data sources: CPS, Health and Retirement Study, Survey of Consumer Finance. And in all of them, you do see this kind of relationship. So you do see some kind of correlation between debt and labor supply. Households with debt work more hours per week, they retire later, they're less likely to quit their job, faster to find a new job when unemployed. And so overall, I do believe that this is pretty widespread relationship. And therefore, it's important. It's important for monetary policy because this effect basically says that monetary policy is going to affect the economy also through the labor supply, especially of indebted households, which works in the opposite direction than the typical effect of monetary policy. But it's also important for the design of debt relief policies, for making loan decisions to begin with, perhaps taking ability to increase labor supply is important when making this kind of decisions. Okay, and very broadly, I do see some similarities between this effect and also the corporate finance Jensen free cash flow result. So we know this result tells us that firms may become more productive when they have more debt. Here we see that households exert more effort when they have more debt. I guess the difference is that it's rather good for firms to be more productive. It's not totally clear whether we're always better off if we exert more effort, but we can ponder about that in the next step. So thank you very much.
All right, thank you, Michael. Our discussant is Amir Kermani.
Okay, do you hear me now? Okay, great. Thank you so much for having me. This is a paper that I very much enjoyed reading it, and it was a great opportunity for me to basically to just learn more from this paper. Okay, so let me just start with, emphasizing on why I do think that this is a very important paper. So I think most of the existing literature that basically try to basically document this, like the mortgage channel of monetary policy, just focus on the consumption response. Basically, they just talked, they just basically investigated, let's say there's a reduction in the interest rates that households are paying, how much their consumption is going to be affected. However, like to the extent that we care about macro implications of these basically changes in the interest rates, or in particular like this mortgage channel of monetary policy, equally important is basically the impact of these changes in the mortgage payments on the labor supply. So the paper that I like the most, basically that documents, that elaborates this framework, that how this interaction between the consumption reaction and labor supply reaction is determining the aggregate impact, is this paper by Aydin, Bankruptcy, and Matt Argyle. And basically, they provide a very simple framework, which I think, this paper can also benefit a lot from it. But in general, I very much like their framework. So basically, they define this MPC, basically, which is like the consumption reaction with respect to a one-time transfer. And then they also define marginal propensity to earn, which is also related to like the labor supply reaction to a one-time transfer. And the very simple, relation that they have in the paper, which basically it's like at the very center of the paper is the ratio of MPE to MPC, like marginal propensity to earn, versus like over the marginal propensity to consumption, is a function of basically the Frisch elasticity over like the intertemporal elasticity of substitution multiplied by this 1 minus complementarity index that they defined. And basically one of the main points of the paper is that this complementarity index is going to determine a lot of like these macro implications of either like fiscal transfers or monetary policies. And like, for example, like historically in the new Keynesian models, sometimes, for example, we just assume GHH model, and that assumes like there's no wealth effect, and therefore the labor supply is very much muted, whereas that doesn't have to be the case in general. So, and in general, it can be like, I mean, we can have like separable preferences. In that case, for example, the labor supply reaction is going to be significantly larger. So what's the main point that I want to say in this slide is that this basically, I mean, this ratio of marginal propensity to earn versus marginal propensity to consumption is a very important factor in determining the macro implications of these either fiscal transfers or monetary policy shocks. And most of the existing literature, or at least the empirical literature, has basically ignored this MPE. And it's not something that we can just automatically infer from the MPCs, because there is this 1 minus CI factor, this complementarity index, which is like, it's at the end of the day, it's an empirical question that what is that 1 minus CI? And it's, I mean, we need papers like Michael paper basically to find out what is that ratio. Okay, so then let's assume that you believed what I said. So then like you may ask, okay, why I can just use like the existing estimates, and why do I need like Michael paper to have just another estimate of MPE? So for example, in particular, there is this paper of Ivan Zator, like that Michael also mentioned, that they, for example, estimate MPE out of like these are the lotteries that basically the winners were receiving an annuity for 20 years. Okay, so kind of something like if you think that like the changes in the interest rates is like a random walk, and the maturity of these mortgages is around 25 years, that's kind of very similar to like the estimates that like Michael is after it. And what they estimate is the MPE of around like between 5% to 12% out of those lottery payments. Then there's also this, this other like, Cesarini and Nadauld paper, which they use like the Swedish data, like the entire population of Sweden. And that one, they use this like MPE out of one-time lottery payments. And they estimate like a relatively precise MPE of 1%. Estimates. And if it happened to be that these like new estimates are significantly larger than before, what should we do with that? And here I want to say that actually we do need like new estimates, and partly because I think in my previous research, it looks like people like, don't think that money is like all money is the same. So it looks like people think about different sources of income differently. Like for example, let's say if it's a lottery income, maybe they think about it like as just something like out of blue, whereas like if it's more planning on it. So I would be totally fine with believing that this MPE could be different for different sources of income. And then if we think that basically these mortgage payments are more prevalent than lottery payments, then I think actually it is important to have like estimates related to these mortgage payments. And then I think a more interesting reason, at least for me, was this like consumption commitment models, that if you have already committed to a mortgage, and if the cost of like missing a payment is very large, you may really want to work harder to just make sure that you are not going to miss a payment. Whereas if I just receive like a random money, I may just ignore that, and therefore my MPE numbers are going to be significantly smaller. So for that reason, I really like, I was super happy to see basically Michael paper. So now, and let me, given the fact that like Michael did like a great job of presenting the paper, I will just jump into my comments just to make sure that I make the best use of my time. Okay. Oh, sorry. Let me just first like one slide on the institutional background and the data, and then the comments. So as Michael said, like all the mortgages are floating rate. That makes like monetary policy, or this mortgage channel of monetary policy, very effective in Poland. Then another very interesting feature of the data that basically is not exploited enough basically in the current version of the paper is that a large fraction of these mortgages are actually denominated in a foreign currency. I will come back to that. And the data that Michael is using, as he said, is basically based on the tax filings. Okay, so my first comment is like as I said, like to the extent that we think that it's because of these consumption commitment models that it's like we really need the MPE estimates for this framework. I think it's very important to also estimate this, like, I mean, it's important to allow for asymmetric effects, meaning that like if there is an increase in the interest rates, that means that I really have to work harder just to make sure that I have enough payment to make for this mortgage payment and avoid default. Whereas if there's a reduction in the interest rates, like there is this asymmetry that on one side, if I don't have the payment, I will default. On the other side, if I have more money, I may not be able to do that much with it. Basically, I have already committed on the size of my home, and all of my other adjustments is going to be on like other consumptions that I'm going to have. So there is this asymmetry between like increasing the interest rates versus reduction in the interest rates. And I think like like this consumption basic commitments models tells us that we expect this like MPE to be larger for increase in the interest rates compared to reduction in the interest rates. So and in the interest rates and reduction in interest rates, if anything, actually reductions in interest rates are more prevalent than increases. So basically my first comment is that I really want to see like these estimates separately for increases in the interest rates versus reductions, because I think it's going to be very much related to the main reason that why we want to have separate MPEs for this framework. So my second comment is that I think actually I wouldn't give up on identifying which are the mortgages that are denominated in a foreign currency and which are the mortgages that are denominated in like, I mean, the Polish currency. And the reason for that is this, that if we look at the period of 2007 to 2009, actually we do see that at the same time that the interest rates, if you remember, increased first and then declined, there was also like appreciation of the Polish currency, like zlotys, and then there was like a very significant depreciation of zlotys. So in particular, what will happen is that for all of those mortgages that were denominated in a foreign currency, if I understood correctly, basically like between 2007 to like 2008, it's true that the like LIBOR rate is increasing, but at the same time, the zloty is like appreciating, or in other words, like the mortgage is depreciating, like the mortgage payments in zlotys are going to be reduced, and the net impact on those with like a foreign with a foreign denominated debt is going to be significantly smaller. And the opposite is true again for when like between 2008 to 2009. So I think like using the time series of the mortgage payments, it should, I mean, you should be able to basically to identify, at least probabilistically, who were the ones who had like a mortgage denominated in foreign currency versus the ones who had a mortgage denominated in local currency. And I think once you are able to identify that, that can also gives you that can also give you an additional source of identification, because then you can even compare like within mortgage holders of even like the same size of the mortgage, those who had like a foreign denominated currency versus like, I mean, a domestic like denominated currency. And I mean, I'm fine with assuming that like in 2002 or 2005, people didn't know that all of these like appreciation and depreciation is going to happen for like zlotys. Like, I think if anything from the literature on like, I mean, in international finance, we think that, I mean, random walk is not a bad approximation for the movements in the exchange rate. Okay, so then, I mean, the third comment that I have, this is like, I mean, is like to what extent, I mean, this is more like a question that related to either changes in the marginal tax rate or tax evasion. And here what I have in mind is this, that like, let's say if there is an increase in the interest rates, that means that there is a higher amount of money that you can deduct from your income. So that can change. And like, I mean, I have to tell you that there is this background that if my understanding is that in Poland, basically there are 2 tiers of like the personal income tax rates, like below an income threshold is 18%. At the time nowadays, I think it's 19%. and above that threshold is 32%. Okay, so like if there is an increase in the marginal tax rate, and that can change my incentive to work, it can also change my incentive for tax evasion, especially, for example, let's say I'm self-employed. I can always come up with some expenses, those things. So it could be that I'm still like earning the same income, but my incentives for tax evasion is less than before. And basically, therefore, in the tax data, I will see more income. So I think there is, the data gives like a very easy way for Michael to address this concern, which is like he can just look at people who, as a result of this change in the interest payments, there was a change in their marginal tax rate versus the ones that there wasn't any change in their marginal tax rate, and see whether the labor supply response was different. The first comment quickly is, I think it would, like, just from the theory point of view, take a look at that paper that I mentioned in the beginning. I think it would be, it makes more sense to just run all the regressions instead of just in levels, just, normalized by the initial level of income. In other words, like at the end of the day, what matters for the households is the size of these mortgage payment changes relative to their initial income. And this is very much also consistent with the heterogeneity result that you showed in the beginning. So I think if you basically do this normalization, both for the income and for the mortgage payments, that also gives you more power to also be able to control for like more accurate, also, more flexible differential time trends for different age groups and income groups. And let me just finish, just to make sure that I'm on time. So basically, the last comment that I have is that I think, to the extent that we may be still worried that some of the loading of these macro variables, at the end of the day, we think that the changes in the interest rates are not random. Usually, like these changes in the monetary policy are associated with other macro variables. So one simple thing that you can do is just control for the interaction of either the treatment group, or for example, the size, the bins of the mortgage, mortgage size, initial mortgage size, interacted with other macro variables to just make sure that it's not this differential loading on macro variables that is driving some of these results. And the very last comment, I think in terms of like clustering, I would rather seeing the clusters to be at the year or year times mortgage size bins, since the main source of variation is just time variation in the interest rates, or like time variation in interest rates interacted with the bins. Okay, that's it. But I truly enjoyed reading this paper. And I do think that this estimate is one of those very important estimates that determines these aggregate implications of this monetary policy, but we have ignored so far. And thank you, Michael, for doing this paper. So we can do a better estimates of these, the importance of this channel. Thank you.
So thank you, Amir, for that discussion. Michael, if you want, you can take a couple of minutes to respond to some of those comments. There's also one question in the Q&A about unemployment insurance, but just take a couple minutes and respond.
Yes, thank you very much, Amir, for the great discussion and for very constructive comments. So yes, let me try to address some. So the first, I definitely agree with the asymmetric response being useful here, and especially what you said about the differences between the lottery estimates. Yes, I do think that makes the importance of increases the importance of looking at the asymmetric response even more. That's true, and that's a good way also to differentiate from this literature. So as we quickly exchanged emails before the talk, I've took a very brief look at this already, and I literally run one regression. So it does seem like the effect is lower for the decreases of interest rates. It still was significant, like positive and significant though. One other thing, however, which the way I think about this is that it's maybe somewhat also related to the context we have here, because just chronologically the decreases in interest rates follow the increases here. And we're looking at the period of growing incomes, growing both nominal and real incomes in the sample. So in some sense, what may be happening is that, let's say, in 2007, 8, 9, you start working more because you need to, because you face an increase in interest rates, and then you kind of slow down. So you don't really decrease your incomes. It's just maybe, you tried so hard in the previous years, now you take a little bit of a rest, you do it a bit slower. So in that sense, I think, I mean, we may be estimating more than a typical effect of an interest rates decline. But you know, I definitely have to exploit that more. It's need to spend more time on this. Then thank you for the suggestion for the currency decomposition. I'm glad to see that you're optimistic on that. So here, let me quickly share. This is what I've created. It's a kind of simulated payments for the mortgage in Swiss francs, and as you could see, it's quite similar to the WIBOR, so that the variation caused by the Polish interest rate, which drives the variation of the mortgages paid in mortgages in Polish zlotys. There are differences indeed, and yeah, I guess let me give it a try more than I honestly thought. That's probably not going to work, but I think, you know, maybe it's worth doing. Maybe it's going to work better. And so yes, thank you very much for all the suggestions. I haven't thought about, for example, the marginal tax rate changing. So that's something which I definitely can explore. I just haven't thought about it so far. And so thank you again for the comments. And if we still have time, let me briefly address the chat questions there.
Why don't you can address those offline, Michael, and we'll go ahead
okay.
and move on to the next paper if that's okay.
All right, thank you very much.
So the next paper we have is Michaela will be presenting borrowing in response to windfalls.
Hey, thank you so much for adding the paper to the session. This looks like 3 great papers, and I'm honored to be part of this. So this paper is titled Borrowing in Response to Windfalls, and it is joint work with Arna, who is here, but she has a baby next to her, so there's too much risk of him waking up. Perfect. Borrowing in response to windfalls. What kind of borrowing are we interested in? We are interested in high interest unsecured borrowing in credit cards, for instance. And this type of household credit, or this position on household balance sheet, has increased quite a lot in the last 50 years. So this is a big fraction of households' debt holdings. And when we look at our economic models, then they make a very clear prediction of when people should borrow using high interest unsecured debt. And that is when they have transitory adverse income shocks. So if I have low income this period, but I know exactly that I'm going to have high income again in the future, then that is the moment when I pay a lot in interest in order to smooth consumption, and I borrow a little bit more for a little while. So now, this is what the models say. And there has been some attempts to look for this type of behavior in the data. And I'd say that the evidence on whether people borrow in response to bad transitory income shocks is somewhat mixed. I'm going to talk a little bit more about that in a second. But there's also a lot of evidence that people do not kind of engage in the other type of consumption smoothing, which is consume very little when they have a positive transitory income shock. So it's a large literature showing that people consume a lot when you hand them cash. So this is the literature. People consume a lot when you hand them cash. I think this is really well established. And then there's a literature that is looking at credit card debt and kind of asking whether this is can be explained in rational models or not. Because even in a rational model, when there's a credit card, to make an agent borrow at 25% interest rate is actually really hard. So there's some attempts to have non-standard preferences to explain the amount of credit card borrowing that we see in the data. And then our paper, I already mentioned this, is related to the literature, whether or not people borrow when they have transitory bad income shocks. And Arna and I have a paper together with Sharon Hundhofter that looks at that using the same data set. We look at unemployment shocks, and there we estimate a pretty tight zero, that people do not seem to respond by borrowing more when they are hit by unemployment, even when they borrow regularly otherwise. And there are some related papers by Scott and Konstantin, but then there are also papers that show that people do borrow when they have transitory income shocks. So here in this paper, we kind of going to look at a little bit of a convex combination between these two literatures. We're going to look at positive transitory income shocks, what we call windfalls, and we're going to look at whether people borrow or not in response to those. And in principle, we would expect people would borrow less. So that is what we're going to look for in the data. Now, just to make sure that you believe me that I'm not just making big claims about the theoretical models without having solved them myself. So we have a model here, which is just a standard life cycle model with hyperbolic discounting preferences following the one by David Lakeson. And there's illiquid savings, so people may lock up their wealth and then they borrow more on their credit cards. So the model is calibrated to match the credit card debt distribution that we see in the US. And I just want to establish here in a very simple regression in this model that when income goes down, then borrowing goes up, and when income goes up transitorily, then borrowing goes down. So both the total borrowing or the log as well as the likelihood to borrow go down when income goes up. So you can see here the person is like 38% more likely to borrow, for example, when he has a bad transitory income shock. Perfect. So what are we looking at? We are looking at lottery winning payments, which are perfectly transitory income shock. We have 37,000 of those in our data. And then these payments are typically pretty small. So the median is just $100. And then I'm just going to show you a raw data graph now where we plot an overdraft indicator. So this is whether people overdraw their checking account. And in the context of our data, this is basically high interest unsecured borrowing. So people in our data don't use their credit cards, they use checking account overdrafts. This is a high interest unsecured borrowing. And we're just going to look at the likelihood to borrow. Before and after they received the lottery winning payment, and we split them by size. So less than $100 payments or more than $100 payments. And so here what you can see is the 5 months before people receive a lottery payment, and then the months in which they receive the lottery payment and afterwards. And you can see here that the likelihood of overdrawing your checking account increases from like 48% to something like 52%. So people are actually more likely to borrow, and we will see they also borrow more when they have a small lottery winning payments less than $100. And here maybe the intuition is people receive a lottery payment of $100, so then they are like, aha, so I'm gonna go out maybe and now go to a fancy restaurant or buy a new sofa, and that costs a little bit more than the $100. Perfect. So now how does this finding compare to the literature? So we find here that the MPC out of these small lottery payments is actually larger than one. People increase their overdraft, so the money has to come from somewhere. And this has been shown in other papers. So there are 2 papers out there which are very different from our setting in terms of the size of the payments. They have much larger payments, but they also find that the MPC seems to be increasing when payments become smaller. So now what you now wonder, of course, is like, first of all, with this data, who plays the lottery is a standard concern when we look at lottery payments, because lottery players may be different from people who do not play the lottery. So now what is another concern is when people play the lottery and how much people play the lottery. And how we're going to address those selection concerns, I'm going to tell you in a second. I'm going to start off with the high level, which is like, who are we even looking at in this data? And then go to the more lower level, which is like, who plays, when do they play, and how much do they play? Perfect. So we have data from a financial aggregation app from Iceland. And we have a bunch of advantages in this context when we look at Icelandic data. For instance, that Icelandic people are such happy lottery players, and we have so many lottery payments in our data, 4 per person on average. These are mostly charities, which is then extremely common in Iceland as well as other Nordic countries. Then the other advantage is that when we have data from a financial aggregator where people link all of their checking and savings and credit card accounts, then whenever they use cash, we wouldn't observe that. However, in Iceland, people use cash very rarely. So that is good news. We have a very comprehensive pictures of people's spending. Then we also have a fairly representative sample because the app is actually marketed through the online banking interface of all the 3 major banks in Iceland. Then we also have pretty accurate categorization because Iceland is such a small country. Everybody kind of lives in the same town. So the categorization of what kind of restaurants, for example, are, like I said, a high quality restaurant, low quality restaurant, or supermarkets, etc. All of this is very accurate. Now the app is only for information, so get an overview of our finances, not transaction functionalities. Now in Iceland, people have a lot of unsecured high interest debt. It's less credit card debt though, it is mostly overdrafts. So people usually pay their credit card in full and then they just overdraw their checking account if they don't have enough money, and then they just roll over their overdraft. There's no discrete overdraft fee, but you do pay monthly interest on the amount of money that you overdraw. Perfect. Here's some screenshots of Arna's account. You can see here we have all the spending transactions, all the accounts, and then some demographic information. You can do fun stuff in the app like setting life goals, setting budgeting goals. You can link all of your accounts of the 3 major banks as well as other credit cards if you have them. Now we compared the summary statistics of income and spending to the representative consumer survey of Statistics Iceland, and we actually get a pretty good match for the categories that match well. So we are quite happy. Half of our people are women, for example, so we do seem to have a more representative sample than you usually have. Now that is the overall sample. Now who's playing the lottery? So overall, almost everybody in the data, 75% to 80% of the people at some point over the sample period receive a lottery payment. So this is how common it is. So we are not so worried about who plays the lottery. What we are a little bit more worried about is when people play the lottery, because when, for example, people always play around Christmas, then, and they also increase their debt around Christmas, then that could be a problem and drive the raw data plots that we saw. So we see that this is a little bit the case, but it seems to be the case that most of the payments, like 90% or so of the lottery payments, are in months that are not December. And of course, we control for calendar fixed effects in all of our regressions. It also seems to be the case that people do not seem to vary much in terms of like the number of lotteries they play. So that would also be a concern, like how much people play like in a certain month, say. So most of the lottery ticket purchases that we see seems to be subscription purchases, which is of course great for identification, because then the transitory lottery payment is indeed just some random payment you receive at some point. Okay. So still, this is, who plays the lottery and also when people play the lottery is not perfectly randomly assigned. So we do find some differences in the non-lottery people and the lottery people. That is not so surprising, but we would argue with all of these differences that they're not super economically significant. It's just that we have a big sample, you have some non-random assignment, and then you look at the differences between the groups. So there are small differences. Same is true when we look at the month in which people receive a lottery payment versus the months in which they don't. We do find some differences there in the summary statistics. Again, we think we are relatively safe on that front because most payments seem to be subscription payments, and we can control for like who and how much plays the lottery with in our regressions. Right. Again, payments here are pretty small. Half of them are below $100. So this is the type of setting that we are looking at. Now, can you extrapolate from the responses that we find here to kind of larger payments? We have to see that we do have some larger payments in the data that we can look at more closely. Right. The type of regression we run is very simple. We look at the outcome variables, say spending or the likelihood of having an overdraft or the amount of overdraft debt or interest payments. And then we have month by year fixed effects, so a dummy for each month in our sample period. And then we have individual fixed effects to control for a time invariant characteristics. And we can also control for other things like income, for example. And here the main thing we are interested in is the indicator for overdrawing, or the number of overdrawn checking accounts, or the interest payments. Let's first look at spending, though. Here we find MPCs that seem to be in line with the literature, and they are bigger than 1 for the small payments. So this is already in line with what we saw in the raw data, that people seem to increase their debt holdings when they have a windfall payment in the months that they have a windfall payment. So this also doesn't depend a lot on when we sort by liquidity constraints, for example. So here we don't find any patterns really, but it seems like people always respond more to small payments. And maybe that is that people get $100 payment and then they're like, aha, I can go ahead and now consume something, and that happens to cost more than $100. So now we're going to look at the probability of having an overdraft. And here we can see that this is majorly increased for the small windfalls by around 10%, which is like almost 20% of the baseline, and also increased by the large windfalls. So we have this result here in our data in the setting of Icelandic lottery payments, that people seem to accumulate more debt rather than less debt when they get a small transitory income shock. And that is the exact opposite of what we would expect from the economic models, where borrowing is used as a measure to ensure consumption. We find the same thing when we look at the number of overdrafts, and I can also show you some pictures. Here we look at spending, right? The spending increase in the months of when people receive a small or a large windfall. And here we look at the overdraft indicator, or the overdraft interest. And we can see that there's an increase in the months that people receive the windfall. And that is especially pronounced for the small windfall, the small lottery payments. Now, another thing we can do is a type of diff and diff, where we look at small versus large payments in terms of the windfall payments. And here we don't see a pre-trend between those people who get a large versus a small payment, but we do see some divergence afterwards. So people seem to respond a lot more to the small payments in terms of their debt accumulation. Okay, so let me wrap up. I think I'm pretty much out of time. So we have a lot of evidence that people consume a lot out of small or large transitory income shocks, and that are perfectly transitory. And in principle, people who smooth consumption should save most of their transitory income shock and spread it out over their entire lifetime. Now, we also have some mixed evidence of whether or not people borrow in response to bad transitory income shocks. So some studies find it, some other studies do not find it. So, and we are here kind of looking at the convex combination between the two, which is like, we ask, if we have a good transitory income shock, do we then see an increase or a decrease in the amount of credit card debt that people have? And in principle, we would expect a decrease, right? Because we think that borrowing is used as a tool to smooth consumption. So people borrow in response to bad transitory income shocks. Now, what we find is that people borrow in response to good news, like good income shocks, and especially when they are small. And the way we explain that in terms of the psychological mechanism is that people have an excuse to splurge, so to say. So they get a small payment, they say, aha, now I can buy this thing, or go to this restaurant that I've been wanting to buy or wanting to go to for a while. Now, what can we learn from that? Can we extrapolate from those small payments to larger payments? Maybe not necessarily to larger payments, but I do think we can extrapolate to the baseline psychology behind why people borrow using their credit cards. So maybe it is not so much consumption insurance, but more in line with kind of self-control, like people borrow more maybe in good times rather than bad times. If they have a lot of debt anyway, and then something bad happens, they don't want to increase that debt. But it is more like when they feel good about the future, that then is when they borrow. Right now, also wanted to say that high MPCs out of Windfalls have been often explained by liquidity constraints, that people cannot borrow before they receive the transitory income shock, so they have to consume a lot out of those transitory income shocks. But that liquidity constraint explanation is, of course, a little bit taken ad absurdum by our results, because the high MPCs are exactly driven by the people who borrow more when they have a transitory income shock. So I'm gonna stop right here and stop sharing my screen. Let Deniz go ahead.
So thanks, Michaela. Just as a reminder, if you have questions or comments for her, go ahead and make use of that Q&A feature on Zoom. Our discussant here is Deniz Aydin.
Okay, can everybody hear me and see my screen in full? Sorry, can you guys see it?
Yep.
Okay, perfect. Okay, yeah, thank you so much. Why am I not starting from the very first one? Okay, yeah, thanks Taylor for asking me to discuss this paper. I felt like it was a really nice paper that is super relevant to kind of all these things that we're discussing about sending people money, and kind of how much are they going to spend, what should be the size of those things, and so on. What the paper basically does is it studies Icelandic folks who play lottery tickets, they win. The first kind of empirical pattern, I guess that's the main empirical pattern, is that these folks exhibit MPCs that are larger than 1. And then how do they finance these MPCs? They borrow in their overdraft accounts, and this is happening in response to a positive windfall, and they roll these kind of overdraft debt over. These effects do extend to liquid folks, but they're confined to small winnings. By small winnings, I mean something like 2% of monthly income. So, of course, this is kind of flying in the face of a lot of what we know about benchmark consumption theory. When I give you $1, what do? You put it into a bank account, and then you kind of eat the interest income. Of course, if you have like a life cycle model, MPC has to go to 1, but that's over the life cycle, right? You don't want to die with the money. So if you're kind of like a young person, you should still do something like annuitizing. And where is this coming from? The earlier equation, right? Marginal utility of consumption today versus tomorrow. So if you wake up tomorrow and then you say, I wish I could take that kind of 1 + 5 MPC that I had spent, just a little bit allocated to today, that would have been kind of more optimal than what I did. This is assuming the U prime C is constant. So of course there are behavioral models where there are like marginal utility shifters and so on. But kind of this paper goes beyond that, because these guys also borrow, they wake up with debt, this entails interest costs, it has to get paid. So it kind of feels like something is wrong. Something is wrong in the sense that I don't think you can generate MPCs larger than 1, assuming the kind of standard assumptions. Of course, I feel like this kind of fits straight into, again, all these kind of debates about kind of fiscal stimulus payments and so on. I feel like we're just sending people money very frequently, almost $500 billion, maybe slightly less every now and then. And then we have a kind of a lot of questions. These payments are increasing in size. There are questions about, for example, should we send people kind of cash, or should we just give people credit lines with 0% interest rate? Because benchmark models kind of assume it gives you the same budget set if you borrow to spend the credit line as cash. Kind of how big should these payments be? Should we send people $2,000 or just, let's say, $100? Are people more likely to save if we give them $2,000? Of course, in the background, there are questions about, is this stimulation? Is this relief? Now we're kind of more thinking it's relief, but what was different previously and so on. I feel like the paper touches kind of a lot of topics about these issues. It's impossible to cover all of them. But kind of one thing that was kind of in my mind is, I think it's kind of super underemphasized, is these super spenders, right? There are a bunch of people, you give them $1 and then they spend more than that. We kind of know that not everybody is in this way, because think about the Keynesian cross. If you have a kind of someone, you give them $1, then they spend $2, then it kind of goes on this way. You have like an explosive economy, right? So we know that not everybody's in this way. It would be nice to kind of understand under what circumstances does this take place. We also have other examples where MPCs could be larger than 1. You get like a gift card from a shop, you spend 10 times that amount, things like durables rebates, or you get a credit limit increase, you infer something about your permanent income, you spend much more than that. But what I basically do is just saving identification and then the interpretation of the results, okay? So just to review it, the data is from Iceland, 400,000 people. The data is from a finance aggregator, Michaela just talked about that. It covers 20% of adults. contains information on spending, income, checking accounts, saving balances at the individual and month level. So cash spending is rare. It means a lot of the personal consumption expenditures are basically going through these electronic formats. The typical income is kind of $4,000 per month. The constraints that, of course, these people have credit card limits, overdraft limits. I just saw the credit limits are about $4,000. So they're kind of like a little bit tight, just 1 month of income. But the main empirical specification has kind of outcomes like spending, an indicator for overdraft on the left. The typical MPC is 2 cents, but for large winnings, it's basically 200 cents. And then people are 9% more likely to hold overdraft when they win these lotteries, okay? So I feel like the main result is the kind of MPC is larger than 1, then the borrowing response is just a wedge that how you finance this. Again, one quick suggestion is if the main result is about borrowing, I would just put the kind of amount of debt that's rolled over to the left-hand side and kind of measure that effect, not as an indicator for borrowing, but also kind of like how much of that larger than 1 MPC is kind of financed by borrowing. Because of course, I mean, there's kind of like this finding where you have $1,000, I give you $100, then you spend all of the 100 and those will go into overdraft debt, although you're liquid. So that's kind of a little bit puzzling. Okay, so I just want to talk a little bit about the lottery and identification. Just a kind of a quick comment. Of course, this is a perfectly identified paper. I mean, compared to the typical kind of empirical paper, I would say this is in the 95th percentile of how well identified it is. But of course, it's just like an intellectual exercise to kind of understand what kind of variation does it have, how do you construct an instrument on basis on that, and so on. So these lotteries are small and one-time asset transfers. Of course, I mean, when you want to estimate an MPC, it has to be, is it wealth? Is it permanent, transitory? Is it unexpected? This is going to be a small wealth shock. The median is $100. Maximum is $1,200. So this is not a jackpot. This is not like you get a kind of check of $10 million and then pose in front of it into the camera. And it's also a frequent occurrence. There's about 40,000 people in the sample who basically win the lottery. So kind of this is happening again and again. Clearly, it's unanticipated. You know you played. You don't know if the money's coming. It's uncertain. And disbursement is automatic. So you just get it. I guess there's just no time frame between when you know you get it versus when you can spend it for anticipation effects. And it's quite plausible that this has no effects on other margins, right? I don't think it changes your credit limit and so on like that. So one thing that I think it would really improve the paper is I feel like there needs to be a lot more details on the features of the lottery. So kind of what kind of lottery is this? Is it like you buy a ticket and there's just 1 million tickets and one person is the winner? Is it like you pick 6 numbers and you can go either buy 1 or 2 or 3 or 6? That's endogenous. And then each lottery, each of the number costs money. Then kind of like there's a formula for how you win. Is this like a kind of machine, almost like a kind of Vegas slot machine, where it's like almost like a Poisson arrival that's exogenous of who's going to win? Are all these winnings from the same brand of lottery? And what are the costs? How much do they pay? What are the chances of winning? And most importantly, what is random, right? Is it like, is it who, how much, and then when? Understanding these things would really help kind of set up the empirical specification. So of course, again, I'm just, again, it's like an identified paper. The comments that I'm making are kind of like taken to the extreme, but to be really rigorous, you really want to understand what is exactly random, because think about different experiments you can run. Think about like a vaccine study. You can encourage people to take the vaccine, so compliance might be imperfect, and the instrument would be more like who's encouraged, interacted with something like time dummies. You can randomize who gets it or when do they get it. The when do they get it is like the kind of Parker et al. Stimulus study based on the social security numbers. Then it's an indicator for when you get it. That's going to be the instrument. You can also imagine scenarios where it's the magnitude that is randomized. I feel like the randomized magnitude would be really nice because it could speak to things like, should we give people $2,000 or $100? How much do they spend differently? Does it really change them? Of course, again, the hair in the jacuzzi here, the concern is kind of who plays, when do they play, how many tickets do they buy? It's kind of like endogenous, right? And then it's like you want to take some risks when you're not feeling well, or like when your need for consumption is high. These are, of course, individual and time varying. So kind of individual fixed effects, time fixed effects, they don't really super help here. Of course, one other concern is that, I mean, if all of the winners are basically coming from the people who play the lottery kind of 10 times a month, then they're 10 times likely to be the winner. And then if this was occurring like once in a million, this might be less of a concern. But if it's happening 40,000 times over the period, it might be kind of more of a concern. Okay. So what I would just do is, in order to use as much of the randomized variation as possible, I mean, they randomize it, it's best if you should use it. And of course, people that use lotteries in the future for identification can then go ahead and cite it. What I would do is just write a set of assumptions where the inference is perfectly valid, okay? And then I would remove them by one, and then just see how things change. So first, I feel like there has to be one type of lottery. If there are different types of lotteries, there's a church lottery, a university lottery, different people play different lotteries. So then you want to kind of avoid that. Maybe that's the case, maybe that's not. Assume that the lottery winner is drawn every T day, so it's like a monthly lottery. It's not like kind of a slot machine where it's like a Poisson arrival that's exogenous. I guess it would be nice if everyone was assigned the number, right? It's like you have there are numbers going from 1 to 1,000,000, and then that not only randomizes who is going to get it, but also how much. If you get if the ticket number 1 wins, you get let's say $1,000. If it's number 2 to 10 wins, you get like a smaller amount. If the amount is random, then you just do all this. If it's the who receives is random, but the amount is not random, then you basically use an indicator for receipt. And of course, the nice thing about the paper is they can observe subscriptions, but the specifications has to be run in a way that it's only the people who are subscribed, or it's only the people who are playing the lottery in that particular period who basically constitute the counterfactual. I don't think it's a concern if not everybody who's playing the lottery actually enters the sample. And of course, you're always measuring the kind of effect on the people who play at that time and the sample who use the software. But I guess it would be nice to kind of like go from the very clean benchmark and then kind of one by one relax those assumptions. Like in the kind of stimulus payment studies, what they do is they always start from the kind of purely exogenous variation and relax it one by one. Okay, so one other comment, this is like really big picture, and I'm working on something very similar, so I think this is very interesting to discuss. A lot of our understanding about MPCs, etc., are built on a specific benchmark incomplete markets model. What we assume usually is that these folks are prudent in the sense that their marginal utility is convex, so even if there is no constraint, a convex marginal utility basically raises the right-hand side of the Euler equation, then you depress spending and low APCs, high MPCs, and so on. And of course, you can also be, I mean, most of the time we also assume risk aversion, right? Risk aversion means you want to keep away from the constraint, even if there is no prudence. So that also depresses spending, and then heterogeneous MPCs that are larger near the constraint. So, I mean, one thing that I felt that we'll be applying here is these folks are lottery players, right? I mean, are these folks really risk averse? Or when we think about like, why do we have the possibility of risk-loving people in economics? I guess somebody who plays the lottery 10 times a month is the person who's most likely to be classified as maybe not risk-loving, but like kind of risk-neutral. There's always a way to get out of this, which is, again, think about like the kind of Rabin's calibration theorem. The fact that you're taking a small local risk might not imply anything about your global risk aversion. If you were rejecting the lottery, then I would say you must be globally really risk averse, but if you accept it, it doesn't matter. But I feel like it's a really interesting exercise to understand if you have low risk aversion, meaning if you have a high intertemporal elasticity of substitution, basically how do these MPCs change? So to understand that, what I did is I basically did like a little simulation. These are showing the MPCs as a function of risk aversion and the discount factor. So it's like an infinite horizon model, super basic budget constraint, super basic credit constraint, isoelastic utility. So when you take the risk up, so if you, of course, if gamma is equal to 0, consumption is linear, then you have risk neutrality. So what I just hadn't realized before is once you make risk aversion go to 0, which means taking the IES go to infinity, the MPCs increase quite a bit. So for example, somebody who has a kind of a discount factor annual of about 0.8, if they had a risk aversion of, let's say, 4, which is some of the common calibrations, they would basically have an MPC that's less than 0.1. But as the IES goes to infinity, these folks are kind of going into 1 in terms of MPCs, okay? So I think it would be really nice to kind of investigate, of course, taking into account the likelihood of winning, the cost of winning, what does the kind of features of the lottery imply? Basically, how does MPCs change for the kind of particular risk aversion these guys exhibit? Also, what fraction of the people exhibit high MPCs? Because these are the averages, so it confines a lot of things like who's near the constraint and so on. And of course, this will have no obvious implication for small versus large payments. Okay, just a few other comments. I have like just only a minute. I feel like one Leibson model, not the beta delta, but the Q-triggered consumption model is very relevant here. Basically, you win the lottery, that's a Q. There are complementarities between that Q and the consumption. So it's almost like going to a bachelorette party, kind of spending it. Why did you spend it? When there was a lot of complementarities in spending. So it's like on the earlier equation on the left-hand side, basically it's not the same marginal utility. Of course, the normative interpretation is very different, and it's not a mistake. You ask them, they would do it again. So repeat winnings might attenuate this. And finally, I feel like there must be an important link to mental accounting, especially when you think about the large versus small. And again, I would just discuss this much more, mainly because it's going to be super relevant how much money should be sent to people, and kind of if you send them large versus small, do they save versus not? Okay. So in summary, super interesting paper, super relevant. I feel like there could be some additions. I will basically tighten up the institutional details of the lottery and the instrument that it gives you, clarify the role of risk-loving behavior, and kind of focus on who are the super spenders, and then what is the source of this size asymmetry. Thanks.
All right, thanks, Deniz. Michaela, if you've got some thoughts on his comments, as well as it seems there's a question here in the Q&A.
Deniz, thank you so much for your careful discussion. This was super interesting. You're entirely right. Beyond just controlling for individual and time, and how much people paid in lottery expenses, we should just provide some kind of nice clean sample splits of only the subscription lottery payments, or excluding some kind of more tricky time periods, for example, December or something. So totally agree with that. In terms of the model, so that was a really interesting, you thought about some stuff that I haven't thought about at all yet. So what I thought about, and I kind of thought was noteworthy, is that even the behavioral models, like even the David Leibson self-control model, the reason to borrow in those models is still consumption smoothing. So whether or not we have hyperbolic discounting, right? The agent is going to consume more when he has a bad income shock, and is going to consume less when he has a good income shock. And Arna and I have now 2 papers that basically show the opposite is true. Mm-hmm. So, and I think it's really good that you point out a model that I haven't really looked at it, that may kind of rationalize the type of behavior that you observe. I think I mentioned the kind of psychological mechanism I have in mind is a little bit that people feel like they have an excuse to splurge or something like that, and just generally that credit card borrowing is something maybe that people do when they feel good, rather than when they feel bad and they really think they have a huge problem. Then I don't go ahead and increase my credit card debt from $2,000 to $3,000. So both of these things were really interesting. So thank you so much. I had one question in the Q&A, which is about the persistence of the responses. So I also thought that those were really interesting, and we have thought a little bit about them. So basically, once you have increased your overdraft once, right, you have to kind of consume less in order to decrease it again. And so we do find very persistent responses for at least, there's some reversion, but at least a few months. And I have been explaining that a little bit. Maybe people have kind of their own limits in terms of how much debt they have. And this is not their overdraft limits, which are pretty high, or their credit limits. But it is kind of like a personal limit. When I reach $4,000, then I feel really bad, because that is an amount of debt that I had very little of the time in my own past, so to say. And I'm kind of wondering in how far that may shift when I have a shock like that, where I borrow more, then this kind of limit shifts. I compare that to when people weigh themselves and they weigh a lot, and they are like, holy crap. But over time, this kind of limit shifts up and up, maybe. So that is what we have been thinking about. And I think those were all the questions, so I'm going to pass it on. So thank you so much, Deniz, again.
All right, thank you. So now we'll go to the final paper of our session. Bronson Argyle will present personal bankruptcy, moral hazard, and shadow debt. It's over to you, Bronson.
Perfect. Okay. Thank you, Taylor. Thank you to the conference organizers for including this paper on the program. This is joint work with Ben Iverson and Taylor Nadauld, both of whom are also at BYU, and Chris Palmer, who is at MIT. Okay, so I don't think that I need to spend a lot of time justifying why bankruptcy is an important topic, so I won't. It's clearly an important component of the consumer credit decision matrix. And what are we trying to answer in this space? Well, we're really trying to answer this question right here. Does the option to delay bankruptcy increase socially inefficient indebtedness? I think this is a really important question that hasn't been addressed to the level that we can address it in this paper. I'm going to show you that the answer to this is yes, that for an exogenous increase of 1 month in the delay to filing, this is associated with a $4,000 increase in unsecured debt for the average filer, and a commensurate increase in shadow debt. Shadow debt is debt that appears to not be visible on a credit report. And I'll have more to say about that too as the presentation moves along. Okay, so just to position this kind of against the backdrop of the existing literature, most of the existing literature that's out there has really focused on the strategic filing decision. So given that a borrower has accumulated an amount of debt, the decision whether or not to file bankruptcy. You think about like recent work from like Sasha and Darte, and she has said this, and I think that she's right, that this kind of existing literature is really an ex post moral hazard, where you've accumulated debt, and then we're examining how the filer thinks about filing for bankruptcy. We are really trying to get at what I would argue is a very different question, which is the strategic debt decision, which is much more of an ex ante moral hazard situation. We want to examine the extent to which filers make decisions about accumulating debt heading into filing. Now, why do I say much more than purely ex ante? It is true that we're going to condition on filers, and so it's perhaps not perfectly an ex ante situation, but I think it's much more than the existing literature. If you think about the closest work here, there's a couple of papers by Michelle White early on, and then I would also highlight this paper by Felipe Severino and Meta Brown, who show using statewide variation that increases in bankruptcy generosity increases total aggregate debt, but doesn't seem to have any effect on overall default probability. We find a very similar result, but whereas I think that their work leaves open the possibility that this is moral hazard, hopefully I can convince you that we go a lot further in being able to say something about strategic debt formation that looks like moral hazard. Speaking of which, when I say moral hazard, I think there's this kind of classic moral hazard definition, which is we have in our minds that individuals know that they're going to file for bankruptcy, therefore they accumulate and originate new debt knowing that they're not going to have to pay it back. But you may have in the back of your mind something like, well, maybe what's going on is not so much a classical moral hazard story, but something like a gambling for resurrection, where individuals are really, they're just trying to survive. They're buying just the necessities of life, just hoping that they can get back on their feet. Now, I want to say a couple of things here. The first thing is, I would argue that if borrowers are unlikely to pay back the debt, then this is still debt that lenders don't want to originate. And these are both moral hazard in the pure like Moskalel sense of what moral hazard is. Regardless of the intentions, these are both really moral hazard. We have a model in the paper, and I'll show that very briefly in the presentation, that shows the equivalency between these two things in terms of their welfare implications. And then at the end of the presentation, I'm also going to show you some extended results that I think are strongly suggestive that what's going on is actually a classical moral hazard story. So even though in my heart of hearts, I actually think that these are the same thing, these are both moral hazard. If you want to think that there's a big distinction between these two ideas, I think that the results of our paper actually tend towards this classic moral hazard story, that people know they're not going to have to pay back this debt, and they originate debt because of that. Okay. So how do I want to spend the balance of my time? I want to talk about the data. I'll very briefly discuss the model, and then I want to spend the bulk of the time on the identification strategy and the empirical results. Okay, so our data come from 4 districts, 4 bankruptcy districts. We scraped the PACER website for Florida North, Florida South, Minnesota, and Utah. We were unable to get a fee waiver for Florida Middle, so that's why we don't have that district. The schedules that we scrape are incredibly detailed. So they have line item information about the assets and the liabilities of a filer. They have demographic information. They have information about their income, their expected future expenses. They're really quite detailed in the amount of information that we get. We take those schedules and we process all but about 15% of those and turn those into a usable form. There are various reasons why the 15% are not processable. But at the end of the day, we end up with a sample of a little bit more than 500,000 bankruptcy filings that span about 15 million individual debt claims. We're going to take this bankruptcy data from the bankruptcy schedules, and we're going to merge it to a sample of credit bureau data that we have. This is going to allow us to construct shadow debt, which I'm going to define formally as the difference between the total unsecured debt that's reported on the bankruptcy filing, less the total unsecured debt on the credit report. Now you might say to yourself, wait, isn't that the whole point of a credit bureau, that it captures the debt that a household has? And I would say, no, not really. The point of a credit bureau is to report all the debt that is reported to them. But there's actually a large number of participants in the marketplace that are creditors that may not think of themselves as creditors. You think about something like a dental office or a hospital. Oftentimes they will do procedures. They're not going to pull a credit report before they do these things. So this leaves open the possibility that shadow debt can exist because of the non-payment of goods and services. Now, this number I think was really surprising for me the first time that we saw this. For the average filer in our data, the shadow debt is about $40,000. Of that $40,000, $30,000 of it is actually in formal categories, things like credit cards, student loans, and personal loans. In categories where we would think the credit report is going to have a very good handle on the amount of debt that the household has. Now, we're going to be much more interested in that leftover $10,000, that uncategorized informal shadow debt. I'm going to show you that that's where all the action is, but I find the summary statistics here also just very, very interesting. How do we get to that categorization? Well, we're going to use an augmented LDA to analyze the descriptions of each one of the loans, and that's going to allow us to categorize each of the loans into a number of different categories. We're going to take these categories and map them into the bins that show up on a credit report. So more specifically, credit card and retail debt, student loans, and personal loans. And then we're going to call everything that's left over that we're unable to categorize as this informal shadow debt. Okay, so in terms of summary statistics for our filers, the average income is about $3,000. Their total assets are about $130,000, and their total debt is about $100,000 more than that. Let me talk just quickly about the model. It's a pretty straightforward model. We're going to call them buyers, but you can think about these as borrowers. We want to think about the implications for equilibrium prices, so that's why we're going to call them buyers. Buyers in our sample know their type. They're either defaulters or they're not defaulters. Sellers don't observe the type, but they know that with probability alpha, a buyer is a defaulter. The only other kind of parameter of interest that I want to highlight is gamma. Gamma is the amount of defaulting buyers that are allowed to purchase the good. You can also think about this as the amount of time that we give to defaulting buyers to purchase the good. Okay, so if we think about the equilibrium price of the good that's going to arise in this model, it's going to be given by this expression, where C is the marginal cost of the good, and beta is the share of total demand that comes from non-defaulting buyers that pay the full price of the good. So if we want to think about the welfare implications for increasing gamma, if we allow more defaulting buyers to purchase the good or give them more time to purchase the good, well, the change in consumer surplus is just going to be the gain in consumer surplus from defaulting buyers who are now able to purchase the good, which is this green rectangle, offset by the loss in consumer surplus from non-defaulting buyers who now have to pay a higher price, which is this red trapezoid. This change in consumer surplus is going to be negative as long as alpha is small enough. I think this is pretty intuitive. You remember that alpha is the proportion of buyers that are defaulters. So if the proportion of buyers that are defaulters is small enough, if you give them more time to purchase the good, the overall change in consumer surplus is negative. Okay, So how are we going to take this model and this idea to data? Well, we're going to exploit exogenous changes to wage garnishment and how wage garnishment affects how fast people file for bankruptcy. The idea here is that the higher my wage, the more of my wages are being garnished, less take-home pay I have, the more likely I am to file for bankruptcy sooner. So how are we going to get exogenous variation in wage garnishment? Well, for a band of the income distribution, the formula for wage garnishment is actually a function of the federal minimum wage. So we're going to exploit changes to the federal minimum wage and how those change wage garnishment for a specific band of income earners. Now, we do a lot of work, and I'll talk a little bit more about this in the presentation, to examine the extent to which it's possible that this minimum wage change changes the composition of filers. We do tests in the paper, and everything that we've looked at, nothing seems to be consistent with this alternative, that the composition of filers is changing because of minimum wage. And kind of other possibilities or threats to our identification is that the magnitudes that we're going to observe are going to be far too large to ascribe to either a direct income effect. So if you think that our results are just being driven by actual minimum wage earners that are earning a higher income now and qualify maybe for more debt, or also the mechanical reduction in wage garnishment. So when the minimum wage law changes, less of my wages are being garnished, which means less of my wages are being used to pay down debt. So mechanically, I'm going to have some more debt. But the magnitudes that we observe are just far too large to ascribe to either of these two channels. I'll have a little bit more to say about that in a couple of slides. Okay, so this is the monthly garnishable wages as a function of income. And as I said, you can see that for this band of income in the middle, their garnishable wages are a function of the federal minimum wage. So we are going to exploit that. That's going to be our treated group, and everybody outside of that income band is going to be the control sample. So then the first stage is the effect of minimum wage changes on the delay to enter bankruptcy. And then the second stage is the effect of this instrumented bankruptcy delay onto debt accumulation behavior. Okay, so how do we measure the delay to bankruptcy? I mean, ideally, what you would want to know is when someone mentally declared bankruptcy. Now, we're going to use as a proxy for that the time between when they were first 90 days delinquent and when they ultimately filed for bankruptcy. And our results are robust to various measures here. You can look at their first 120-day delinquency, their most recent 90-day delinquency. The point is that you want to measure for how long an individual is in distress. And using the measure that we use here, the average time is a little bit less than 2 years, and the median time is a little bit more than a year. Okay, so the first stage specification then is going to be this delay to bankruptcy, the months to file, onto the variable of interest is this interaction between a treatment dummy and garnishable wages. Now, of course, we want to control for income. So we're going to control for income here through the interaction of treat and income for income in the treated sample. And outside of the treated sample, in the control sample, income and garnishable wages are actually collinear. So we are controlling for income for the control sample here and the treated sample here. Okay, we're going to include a host of filer controls, and then we'll use various fixed effect structures that include the bankruptcy district and the filing year. And then if you think that it's possible that what's driving this is some nonlinear relationship between income and debt accumulation behavior, we're also going to have some specifications where we include income, various measures of income as well. And then we'll double cluster the standard errors by month and 3-digit zip code. Okay, so let's look at the first stage. What we see is that for a $100 increase in garnishable wages is measured in $100 increments. We see that across specifications on average about, this leads to a month reduction in the delay to file for bankruptcy. Now, if we talk just kind of briefly but seriously about the exclusion restriction here, the exclusion restriction is that conditional on income and our other controls, changes to the minimum wage don't affect filer debt levels directly, but only do so through their effect on timing. And as I noted before, one possible threat to this is that there's selection into who files for bankruptcy, so that we have a change in the composition of filers. we do a lot of work in the paper. I won't show these tests here, but they're in the paper that make this story difficult to tell. If you look at the likelihood that someone files for bankruptcy, this doesn't change as a function of minimum wage. The debt levels of non-filers don't change. So if the composition of filers is changing, then there must also be a commensurate change in the composition of non-filers. We don't observe that. The income distribution doesn't seem to change either. And not only kind of these tests, but also the existing literature that has looked at the extent to which changes in things like this the Severino and Brown paper that I mentioned before. It doesn't appear to be the case that these kinds of changes to bankruptcy generosity, or in our case, changes to wage garnishment laws, affect the ultimate outcome of whether someone files. So I'm more than happy to talk about this more, but this is kind of how we have thought about this. We're also doing some other tests to try to push on this even more to make this a more difficult story to tell. And kind of along with this is, again, this thing I said about the magnitudes are really difficult to ascribe to either direct income or garnishable wage effect as alternative explanations. Okay, so let's look at the reduced form second stage. So this is the unsecured debt share. So this is unsecured debt as a fraction of total assets. You can also look at this as just the log of unsecured debt. If you want to just look at the numerator, you get very similar magnitudes. Okay, what we observe is that for a $100 increase in garnishable wages, you have about a 50 basis point reduction in the unsecured debt share, which is about $1,200. I think that these results are a little bit easier to interpret in the two-stage least squares framework, where we find that an increase in the delay to file for 1 month corresponds to about a 1% increase in unsecured debt share, which is about $4,000. Okay, so we can push beyond this and we can ask the question, well, what kind of debt do delaying filers incur? Let's look at shadow debt. And we do observe that in fact, what kind of debt do they accumulate? They accumulate shadow debt. We see that for an increase in the delay to file of 1 month leads to about a 1.7% increase in shadow debt, which is about $6,300. We can't reject the hypothesis that these coefficients are no bigger than the coefficient on unsecured debt share, meaning that it's possible that the entire increase in unsecured debt share that we observe is shadow debt. Okay, and in the last like 2 or 3 minutes that I have, okay, let me just show a graphic of this too. That it is certainly the case that changes to the minimum wage affect the treatment sample, and they appear to have really no effect on the control sample at all. Okay, so in the last couple of minutes that I have, let me push on these results a little bit. The first one is to say, well, let's look at the categories of shadow debt. It would be weird if we observed an increase in formal shadow debt. These are debt instruments that require a formal process. It would be very difficult for someone who's already in distress to be able to increase debt of this type. And indeed, that's what we observe. We see no increase in formal shadow debt. All of the increase is in this leftover, uncategorized, difficult to put into one of these traditional bins, shadow debt. Okay, so what have I shown you? I've shown you that for changes in the minimum wage, we see that filers take longer, and with that longer time, they accumulate more debt. But I want to return to this question, as I said that I would, about whether this is kind of a classic moral hazard story, or is this a gambling for resurrection story? To try to get at this, what we're going to do is split the sample into individuals that we think filed for non-strategic reasons. So we're going to identify a group of people that are non-strategic and a group of people that are, we're going to split the sample into individuals that we'll call strategic and non-strategic. We're going to say that the strategic people, they had very low medical debt, they are employed, and they're not separated or divorced from their spouse. These are individuals that seem to have filed for reasons other than an exogenous life event. So if we think that, the type of people that are going to be running up the tab and are going to be originating debt in a moral hazard sense are the individuals that didn't have some like really bad thing happen to them to push them into distress and they ultimately had to file for bankruptcy. This would take a step in getting us in that direction. Okay, if we rerun our results, what we find is that the first stage, we see no significant difference between these two samples. Both the strategic and the non-strategic sample, they both delay by about a month, but they do very different things with this month delay. What we see is that all of the debt accumulation results that I showed you before, they're all in the strategic sample. This is the unsecured debt share results. You can see that the difference is significant. This is the shadow debt result. This is the informal shadow debt result. All of the results that I showed you before, they're all concentrated in the sample of individuals that we think are filing for a non-exogenous life event reason. This is consistent with, I think these results are important for two reasons. One is that this is consistent with this kind of classic moral hazard, like people are running up the tab in an intelligent way. Two, this makes it very difficult to tell a story about an income channel or a direct wage garnishment channel, mechanical wage garnishment channel, because that would affect both of these samples identically. Okay, so in conclusion, I think I'm a little bit over. What have I shown you? Bankruptcy filers that can file more slowly, they incur more unsecured debt. That the ability to delay bankruptcy leads to moral hazard, that if we separate the sample, like I just showed you, it appears that the individuals that we think are most likely to be filing for strategic or endogenous reasons, those are the ones where we see the debt accumulation behavior that I've demonstrated. And then there's this whole piece about shadow debt. The shadow debt is an important piece of the balance sheet of bankruptcy filers, and that's the kind of debt, more specifically informal shadow debt, is the kind of debt that bankruptcy filers run up if given an extension to their delay of filing. What this all boils down to is that any policies that are going to allow us to better monitor bankruptcy filers, to identify them more earlier and help them and shepherd them through the bankruptcy process sooner, could potentially be a welfare improving. So thank you. That's everything that I have. I look forward to Arpit's discussion and to still Deniz's line to find the hairs in our jacuzzi, I believe was the expression.
Very nice. Thanks, Bronson. So it's over to you, Arpit, to discuss the paper.
All right, thank you so much for inviting me to discuss this really interesting paper. I want to kind of first start off by talking a little bit about, sorry, I don't think you can see this here. All right, you should be able to see this. I'm going to first kind of start off by talking about a paper that Chris Paulman and I saw by Luck and Santos. So in kind of thinking about, well, why is it possibly important to think about household strategic behavior, right? Why might this kind of be a really important concept? So, this paper by Luck and Santos looks at the secured, unsecured spread for corporate borrowing. So using this kind of battery of fixed effects by bank, firm, originator, date, and so on and so forth, what is the difference in borrowing rates that corporations pay? And it turns out to be about 19 basis points, right? So I'd say that's kind of almost minuscule. And I found that a really amazing paper because if you think about any comparable spread in household borrowing, you're going to come up with a number that's an order of magnitude much higher, right? So if you think about the difference in borrowing for revolving debt for a household that takes a HELOC, which is secured by the house, or just uses a credit card, that's on the order of like 12%, right? And if you look across household borrowing categories, things like student loans, autos, mortgage debts, areas in which there's collateral or higher degrees of being able to garnish, you kind of find the interest rates are very responsive, basically, to the extent of recourse that lenders have on households. And that's very different from the pattern that we see in corporations. So that's just sort of suggestive evidence here that strategic behavior on the part of households, some sort of ability for households to be able to engage in moral hazard, is kind of seems to be a really important priced characteristic of household debt. And that's kind of a really important distinguishing feature relative to other categories of household debt. So while there's kind of a lot of recent work kind of emphasizing adverse factors and things like cash flow shock and explaining household factors, I still think it's really important to also keep into context why strategic behavior might be a really important part of the story as well. And so I'm really favorable ex ante to the analysis that the authors are doing in this paper, which is to kind of tease out what are some more of these channels and ways in which strategic behavior by households can matter. So what this paper does is a few different things. So it's going to first show you that the changes in federal minimum wages are going to affect the wage garnishing. So moving to kind of this higher federal minimum wage level is going to lower the required wage garnishing, right? So it's a really interesting instrument here that's going to result in variation in this wage garnishing feature, which is going to be an important first stage So this kind of treatment of garnishing wage is going to delay households so they file for bankruptcy later. And they're going to use this delay to observe that households are using this delay, and they are, as a result, increasing particularly their unsecured debt and areas that are really concentrated in shadow debt and debt areas that are not reported to the credit bureaus. So I found this a really fascinating measurement. Shadow debt is kind of something that is sort of a topic of really broad interest that we are not really able to measure. And so this is kind of a huge data improvement relative to the literature. So I was really excited by that part about it. And it has a really important implication, which is that lenders are adversely affected in some way by these household choices that happen in this immediate pre-filing window. Okay, so I'm going to do 4 things in my discussion. I'm going to talk about the power of the exercise. I'm going to have some suggestions on the sample construction related to that. I'm going to talk a little bit about this confound from the direct minimum wages. They kind of touched on this a little bit in the discussion. And I'm going to conclude by thinking about, well, whether this really does constitute strategic behavior. So this is a little bit of a cheap shot as a discussant, but it's sort of an important point nonetheless. So here is the first stage of the analysis here that you just saw. So this is the relationship between the treatment variable here interacting with garnishing wages, right? So looking at the subset of the distribution that is really affected by the change in the minimum wage policy and the impact of that kind of treatment on the relevant population regressed onto the timing delay, right? And what I want to draw your attention to in particular is the F statistics that we have on the bottom here, right? So they kind of range depending on the specification. They go from 4.31 to 9, depending on what we're doing, right? So in kind of this first column here, we've got controls for the filer, the year, the district. On the second one, we don't have the year and district controls, but we're interacting district by year. And then in these last couple ones, we're adding income by year and then income quartile controls as well. So I don't have like a great ex ante reason to think that one of these specifications is necessarily that much better than the other. They all seem to me kind of plausible ways of getting at this. And one thing that does kind of worry me a little bit is the extent to which these F stats really do vary depending on the precise mix of specification controls that you have in there. And they're all kind of uniformly sort of relatively low. So I'll talk about that in a second, but I want to show you that this is not just like some kind of minor concern that you might have about the power. It really does filter into the kind of credibility of the overall estimates here, right? So I'm kind of breaking out these estimates into two colors here. The ones in red correspond to, these kind of 2 specifications here that had the relatively higher F stats. And you can see that those ones are significant. So they the kind of 2 stars. The 2 ones in the middle there, the ones corresponding to the lower significance first stage F stats are actually insignificant, right, by kind of conventional measures, right? So this would sort of suggest that there is sort of a concern about a weak instrument that kind of manifests into the baseline estimates here, really varying whether or not they kind of reach statistical significance, kind of depending on the precise specification, whether or not the F stat and the significance from that specification. And it results in a sufficient power to be able to detect the size of the effects, right? So kind of digging back into a little bit of this literature on, well, what kind of, F-stat should we expect, how to kind of think about this weak instrument issue. The kind of classic standard in this literature here is Steiger and Stock. They suggest a rule of thumb of an F-test of at least 10. Stock and Yogo suggests kind of more like 16.38. So that's kind of the critical value of an F test with one instrument, which is sort of the setting here. I'm more of an empirical guy rather than sort of a econometrician. So I just like looking at the distribution of what F test papers actually do use. You see that there's some bunching here around the 10 F test of F stat of 10. That bunching might be a problem for a separate reason, but I just kind of want to highlight that if you think about the F tests that the author's reporting, they really are on the low end of this distribution. Right, so they're kind of on the far low end of what is generally considered permissible for publishable papers. And there's even, if anything, there's even more recent research by Lee, McCrary, Marrera, and Porter, which argues that actually the F tests, F stats we should be using are really more like 105 across all of our IB specifications. Right, so they're it's kind of a provocative claim. They're sort of, or alternatively, if you want to use the F of 10, you really need a T-stat of like 3.43. It's a little bit of a provocative claim. It argues that essentially a large chunk of the IB literature is just really substantially underpowered. but I kind of want to be a little bit more constructive in this discussion and kind of suggest some ways I think the authors can actually expand their sample and think about ways of kind of addressing some of these weak instrument problems. So first, it's kind of important to run through what they exactly do in this paper. So they look at people who have or had mortgages. Maybe it's because I'm a real estate person. I don't find that like a bad restriction. I think it's perfectly fine to look at people who have real estate. They look at a few different states here, and they're missing bankruptcy data for part of Florida. They're merging the credit report bureaus using 3 and 5 digit zips, and then the month of the bankruptcy filing. And then to kind of settle ties, they're looking at first mortgage amounts that lie within 10%. So 53% of them are actually within 1%. I'll come back to that sample later. That results in an N of about 55,000. And then they look at households that have 30 days at least between the first period of missing 3 payments and the bankruptcy filing. And then they do something called filtering on income similar to the broader sample. I wasn't entirely sure what that means, but that basically gets us down to 48,000. What I want to flag is that there are a lot of cuts along the way that kind of change how they take their broad sample and filter down to the analysis used in the regressions. And I think that kind of thinking about all these checks and trying to use the broadest possible sample will be one way of trying to address some of the weak instrument issues. So basically, do you need all these restrictions, right? So the fact that you have kind of a restricted sample anyway, the fact that you're looking at homeowners kind of means that it's selected. And so I don't think it's necessarily that important to try to ensure further comparability. And I think you can actually just use the broader sample without the credit bureau data for a lot of your tests. So if you're thinking about like the first stage regression of the impact of this federal minimum wage on filing delay, that's something you can use the entire data for, right? You can even look beyond the states that you have credit bureau data for and try to get an even broader sample of PACER. I also think it'd be helpful to kind of think about other sources of delay in bankruptcy filing. Maybe there's seasonal facts, things around Christmas. To the extent that those result in sort of similar facts, you might be able to use multiple instruments here to try to kind of get a variety of different things all pushing the same direction. There's a paper here I'll recommend that's sort of an IV for free strategy that uses some machine learning techniques to also kind of eke out a little bit more sort of power here. And then I'd also kind of recommend a formal specification test. So these are kind of the tests where you have kind of a graph and you kind of permute all the possible specifications you could run, right? Try this fixed effect, try that fixed effect. And I think that would be a more algorithmic formal process to kind of show how the effect sizes and the significance kind of changes across specifications rather than just kind of cherry picking and showing a couple to the authors, to the reader here, right? So just being able to kind of see the full distribution of like, how do the effects look like across all possible covariates you could throw at this model would I think give a lot of credence to kind of your point if you kind of see really similar effects across all of those, even if, some fraction of those specifications don't have significance. And then finally, one thing I thought was really, really cool was this sort of 1% sample. So the fact that you've got this 53% of people that are actually exactly right. I think that's a really important robustness test to use exactly because the key concern about measurement error here is it comes from the fact that you're defining shadow debt based on a difference between the credit bureau and the bankruptcy filing. And so the concern is that you just match the wrong people, right? And if you kind of take people that are within a 10% tolerance band, you're already acknowledging up front that there's going to be some mismatch somehow or some misreporting somehow. And so looking at people that are reported exactly is going to just make sure that you are using them kind of the tightest sample to kind of measure the shadow debt with. And I think that'll be a really important robustness test to do. I'm not going to spend too much time on this because I don't think it's an important concern. But Bronson kind of just alluded to in the paper that that minimum wages do just have a direct impact on wages themselves and potentially in potentially complex ways, right? They could result in job loss if you really believe the idea that minimum wages have this disemployment effect. They could result in increase in cash in hand. We know from Michaela's paper earlier that kind of windfalls may kind of actually increase household indebtedness for various reasons. So I just think it's kind of an important story that you just kind of need to formally rule out in the paper that the minimum wage is kind of directly affecting household, debt repayment patterns. I think you can do that in various ways, for example, by trying to isolate borrowers sort of closer or further to these federal minimum wage levels who are likely to be less affected by the kind of direct minimum wage thing. And the last thing, though, is kind of conceptual, is like, is this really strategic behavior when we document that borrowers are kind of showing up with more shadow debt, right? Kind of, as they're sort of filing, right? So we kind of like typically think about strategic default in this context, it would be something that's either like more consumption during this kind of late stage, or some sort of delay of bankruptcy filing beyond the point that's sort of socially optimal. And the paper kind of says that, well, these are both kind of hidden actions. This distinction doesn't really matter for the lender's perspective. It's all kind of more debt that they're kind of, forced to kind of deal with, and, results in potentially more cram downs or something for the lender. But, let's kind of think about like, what is this shadow debt, right? It's stuff like bounced checks, unpaid medical, utility, telecom bills, fines and fees. And it just kind of raises this question of like, is this really strategic behavior on the part of the person? So if you had told me like, look, people that are about to enter bankruptcy rack on a ton more credit card debt, I'd be totally with you, right? That's a very natural story to tell. The fact that it's showing up in this category that in many ways seems to reflect things that are passive to borrowers rather than active choices kind of raises some concerns, right? So the concern is specifically that, well, people are just kind of going about their lives. They're kind of passively accruing these fees and expenses, particularly when they're already in distress. They're not kind of really making active choices to kind of consume more. And that kind of raises some questions about whether it's sort of socially optimal to think about these kind of debt kind of claims. So sort of the alternate story I guess I have in mind is that people are just kind of averse to filing for bankruptcy. It's kind of this gambling for resurrection story. They're not like racking up additional debt, but they're just sort of like accruing these fees and expenses that are sort of associated with the distress. But a problem here is that because you're conditioning on bankruptcy, you don't see the benefit to creditors of any delay in helping them get back on their feet, right? So if it was this kind of pure gambling for resurrection story, some borrowers would benefit from the delay. You don't observe them. They don't file for bankruptcy. Other borrowers really hurt, and that's the kind of ones you're kind of capturing. The main things the paper is doing to look at this have to do with subsetting tests, so looking at bankruptcy motive. I didn't really find these fully conclusive because they don't really establish the nature or kind of rationale for these borrowers' hidden actions during the delay stage, right? That's really the key question. Is like, why and how are these borrowers adding on this shadow debt? And knowing the ultimate kind of reason for the bankruptcy filing doesn't fully answer that question. Again, from the lender's perspective, maybe you don't really care. This delay is still bad. But for our perspective of trying to understand household behavior, I think it is important to kind of distinguish whether this sort of strategic behavior is really like looks strategic, it's like more consumption, or it's just kind of the side effect of households are kind of caught in some sort of debt trap or hidden fees that they're finding it very hard to escape from absent bankruptcy filing. So I don't have a great suggestion here. I'd kind of suggest the authors kind of maybe tone down the language or dig deeper into these bankruptcy files to kind of really figure out what's actually going on here, or just kind of provide more guidance to the author of like, is strategic like really the right framing for household behavior in this context. A smaller point here, I think strategic could also be just kind of another balance test item in that appendix table. But I really like this paper overall. I think this like contribution of like being able to measure shadow debt in bankruptcy is a really nice thing that I haven't really seen in other papers. And I think, I very much hope that they're going to use this data field for kind of future work. I think that the paper also has a really nice contribution in arguing for strategic decisions. I'm ex-ante very sympathetic to this notion. I think it kind of makes a lot of sense if you think about kind of the pricing of household debt. And I kind of offer some suggestions to the authors on how to refine that further.
Great. So we've got about 2 or 3 minutes before they force us out of the room. Bronson, did you like to respond to some of those comments?
Yeah, sure. I mean, thank you, Arpit. Like, as always, like, I think really, really thoughtful and really good things for us to think about. Let me touch just kind of briefly on some of the high points. I think, in terms of the weak instrument, there are tests that you can do too. We've looked at like K-class estimators, like following kind of Hahn and Hausman, and they seem to pass all those tests. But I think, your point is well made. In terms of the shadow debt being due to a bad merge, this is, I think, for sure, like a knee-jerk possibility and makes a lot of sense. I feel really confident that that's not what's going on. Those shadow debt numbers are identical. If you look at the individuals that are like 1-to-1 matches, where it's like there's only one individual in our data set, and there's only one individual in the credit report data that declared bankruptcy, these have to be the same person. And also the mortgage amounts, I think we need to maybe be a little bit more precise in the writing, because we only use the mortgage amounts for some of the sample. So when we do have mortgage amounts and can compare them, they're within much better than 10% for much more than 50% of the time. If memory serves, it's something like, they're within like 2% of each other for like 80% of the sample or something like that. It's only when we use that. So anyways, I think, in terms of pinning down whether this is actually like classic moral hazard or gambling for resurrection, I don't think that the triple diff results at the end are perfect, but I have trouble coming up with an alternative explanation that makes sense, right? I mean, all the things that you mentioned about this potentially being just gambling for resurrection, if that's the case, then I don't know how to think about why I would observe all of the effect in this strategic sample and really nothing in the non-strategic sample. And so I think your point is well made. I mean, and we should probably tone it down in the paper, and that's probably me more than it is the paper, just because I find it hard to think of any other alternative explanation that really jives with these results. So I think your points are well made. Whether we should use the term strategic or not, like I said, we go back and forth on this. Michelle White says use strategic. She said it was great and liked that language. We've had other people say different things. So, but really great comments. Thank you for your feedback.
So just wrapping up before they kick us out, thank you so much to the presenters for bringing some interesting research and for the discussants for devoting time over the holidays to discuss it. Thank you, and I hope to see you all again in person sometime soon.
Thanks, everyone.
Thanks, Taylor.
Thank you very much.
Bye.
Thanks.
Take care.